Hey everyone, and welcome back. We're diving into a world today where things aren't always as they appear.
Oh, yeah, a world where numbers can be a bit like camouflage.
Exactly, we're talking about accounting fraud.
A place where financial statements might not tell the whole story.
And, this isn't just for the finance nerds out there.
Right, this stuff matters whether you're an investor or just someone who wants to understand how businesses really work.
Absolutely, because let's be honest, we all want to know what's really going on behind those
What?
fancy reports, right?
Yeah, who doesn't love a good detective story?
Especially when it involves our money.
That's where you come in, right? You're the expert at spotting these accounting tricks.
Well, I try to be. I like to think of it as helping people see through the smoke and mirrors.
So today we're going to be focusing on the types of accounting fraud that can really make a company look healthier than it is.
Kind of like putting lipstick on a pig, as they say.
Exactly. And we're going to use some real-world examples to show you just how it's done.
And the best part, we're going to give you some tools to spot these warning signs yourself.
Empowering you to make smarter financial decisions.
So, before we get into the nitty-gritty of specific cases,
Yeah, let's lay some groundwork.
what exactly is accounting fraud?
I mean, is it just like fudging a couple of numbers here and there, or is it something more?
Like, is it a crime? Is it unethical? What are we talking about here?
Yeah, it's definitely more than just rounding up a few pennies. We're talking about intentional misstatements or omissions.
Okay, intentional, so it's not an accident.
Right, and these misstatements or omissions are made in a company's financial reports.
And the goal here is,
The goal is to create this distorted picture, making the company look way better than it really is.
so it's like creating a facade, an illusion.
Absolutely. And there are a ton of different techniques to do this.
Oh, I bet. So what are some of the more common ones?
Well, some of them involve straight up fabrication.
Really? Like making stuff up?
Oh, yeah, like making up sales that never even happened.
Wow, that's bold.
But then there are others that exploit loopholes in the accounting rules.
Ah, so bending the truth without technically breaking the law.
Exactly, kind of like following the letter of the law, but not the spirit.
Clever, but sneaky.
And it's amazing how creative some companies get with these manipulations. It's almost like a game.
Right. Except the stakes are way higher than a game.
Oh, yeah, for sure. And the reasons why companies do this can vary.
So it's not always pure greed.
Not always. Sometimes it's just intense pressure to hit those earnings targets.
I can imagine. Got to keep those investors happy.
Exactly. Or even just to keep up with the competition.
It's like this unspoken pressure in some industries to play the accounting game, right?
Yeah, you get this everyone's doing it mentality, which can be really dangerous.
Okay, so we've got the basics down. Now let's get into some real-life examples of how this plays out.
Sounds good to me.
Let's kick things off with a company that was once the darling of the UK stock market, Colorol.
Ah, collateral.
They seem to be on top of the world in the 80s.
Right, but then they collapsed. Spectacularly.
All thanks to their accounting gimmicks.
It's a classic example of how aggressive accounting practices can backfire. Big time.
So what do they do? How do they pull it off?
One of their favorite tactics was manipulating goodwill write-offs.
Okay, back up for a second. What's goodwill?
Goodwill is like this intangible asset.
Intangible, what does that mean?
It's not a physical thing you can touch. It represents things like brand value and customer relationships.
Ah, okay, so like the reputation of the company.
Exactly. And when a company buys another company,
They usually pay a premium, right?
yeah,
Because of that goodwill.
right, they assign part of the purchase price to goodwill.
So it's like saying, we're paying extra for this company because its brand is strong and people love it.
You got it. But what Colorol would do is write off a big chunk of the purchase price as goodwill.
And what does that do?
It reduces their expenses on paper and makes their profits look bigger in the short term.
Interesting. So they're making those acquisitions look cheaper than they really were.
Precisely. And this allowed them to report these amazing profits, which kept investors happy and their stock price high.
Classic smoke and mirrors.
But there's more.
Oh.
They also took on a ton of debt from the company they acquired, but they didn't exactly advertise that.
They kind of bury that info, huh?
Yep, tucked it away in the fine print.
Out of sight, out of mind, until it's not.
And that's what happened with Colorol. Their accounting tricks couldn't hide the real problems forever.
The truth always comes out right.
It usually does. And when it did, the company went under.
So this case shows us that even when a company seems to be doing well, you can't just take their word for it,
No, gotta look under the hood.
especially when it comes to acquisitions.
Lots of opportunities for creative accounting there.
So lesson learned, If a company's goodwill seems to be growing really fast after a bunch of acquisitions,
That's a big red flag.
time to dig a little deeper.
Absolutely. Understanding how companies play with goodwill is essential for spotting potential fraud.
Because remember, financial statements are basically stories,
And sometimes those stories are more fiction than fact.
and it's up to us, the readers, to figure out what's really going on.
To be a little bit skeptical, a little bit detective.
Exactly. Like reading a mystery novel and looking for those clues.
You got it. And that's what makes this stuff so fascinating.
It's like a puzzle waiting to be solved.
And sometimes those puzzles can save you a lot of money.
Absolutely.
Hmm.
But hey, there's more to this puzzle, right?
Oh yeah, we've only just scratched the surface.
We'll be back after the break with more tales from the world of accounting fraud.
Welcome back, everyone. We're continuing our exploration of accounting fraud. You know, Colorado Story is a good reminder that things aren't always what they seem, even with companies that look successful.
It's like they built this whole empire on a foundation of sand.
Exactly. And now we're going to look at another company that got a little too creative with its accounting. British and Commonwealth, or B&C.
BNC, okay, what do they do?
They were masters of something called off-balance sheet financing.
Off balance sheet. That sounds a bit like hiding something.
It kind of is. Imagine you've got a closet full of clothes you don't want anyone to see. What do?
Stuff them under the bed. Out of sight, out of mind.
That's basically off-balance sheet financing. Companies create these separate entities, often with really complicated ownership structures, to hold stuff they don't want showing up on their main balance sheet.
Ah, so they're hiding their dirty laundry, so to speak. Makes their finances look better than they really are.
Precisely. And it can work for a while. They maintain this facade of stability.
But like you said, eventually someone's going to open that closet door.
And that's exactly what happened with BNC. Their off-balance sheet activities eventually came to light, and it all came crashing down.
Ouch, not a pretty picture. Do you have a specific example of how they did this?
Their acquisition of Atlantic Computers is a good one. Atlantic was already playing some accounting games of its own, especially with its leasing business.
Leasing, huh? What were they doing there?
They were booking profits up front on these long-term leases, even though they wouldn't actually get the cash for years.
So it's like inflating their short-term profits to make it look like they were doing better than they really were.
Exactly, like blowing up a balloon looks impressive until it pops.
And when B&C bought Atlantic, they got all those accounting problems along with it. It all came back to bite them in the end.
So we've seen goodwill manipulation with Colorall, and now off-balance sheet financing with BNC. Acquisitions seem to be a common theme here.
You're right. Acquisitions can be tricky. You're merging different systems, valuing assets. It gets complicated.
And that complexity can create opportunities for hiding stuff, right?
It definitely makes it easier to pull the wool over investors' eyes. That's why it's crucial to be skeptical and really scrutinize those financials.
You know, I always thought depreciation was pretty straightforward, but it seems like even that can be manipulated.
Oh, absolutely. Depreciation is all about how companies account for wear and tear on their assets over time.
Right, like a car loses value as it gets older. Exactly. But companies have some flexibility in how they choose to depreciate things, and that can impact their reported earnings.
More flexibility, more room for playing games.
That's the idea. For example, let's say a company buys a bunch of delivery trucks. They could assume those trucks will last 5 years, or they could stretch it to 10 years.
And that changes how much they depreciate each year.
Exactly. If they choose 10 years, their annual depreciation expense goes down, which makes their profits look a bit higher.
So they're basically tweaking the timing of those expenses to make things look the way they want.
You got it. It could be about smoothing out their earnings, making them look more consistent year after year, or it could be about reducing their taxes.
It all comes back to painting a pretty picture for investors.
And that's why it's important to understand these techniques and to look for any red flags.
Okay, so we've got goodwill manipulation, off-balance sheet financing, and now depreciation tricks. What else do we need to watch out for?
Well, let's talk about currency mismatching. Peck is a classic example of how that can go wrong.
Peck, what do they do?
They were really good at exploiting differences in interest rates and exchange rates between different currencies.
Sounds complicated.
Imagine borrowing money in a currency with low interest rates, say US dollars at 2%. Then you invest that money in a currency with much higher interest rates, like maybe Turkish lira at 10%.
That sounds like a pretty good deal. Make a nice profit on the difference.
Yeah, except exchange rates can change. If the Turkish lira weakens against the dollar, your profits could disappear. You could even end up losing money.
Ah, so there's a lot of risk involved.
Peck was basically betting big on favorable exchange rates. And
Yeah.
for a while, it worked. Their profits looked great, their stock price was soaring, but eventually their luck ran out. The Turkish lira crashed, wiped out their gains, and they went bankrupt.
So it's like playing roulette. You might win a few times, but in the end, the house always wins.
That's a good analogy. Peck's story shows how dangerous it can be to rely on these complex financial strategies.
It seems like there are a lot of ways companies can manipulate their financials.
It's true, but the more we understand these techniques, the better we can protect ourselves.
Knowledge is power, right?
Yeah.
What about extraordinary and exceptional items? Those sound pretty harmless.
Ah, yes, the realm of the unusual. They might sound straightforward, but they can be used to manipulate earnings.
So they're not things like, finding a winning lottery ticket on the street.
Ha, not quite. Although
Excellent.
you're on the right track with the outlier idea. Extraordinary items are really rare.
Okay, so truly unusual and they don't happen very often.
Exactly. Think like a massive earthquake that shuts down your factories, or maybe selling off a huge chunk of your business.
Okay, so things that are outside the normal course of business.
Right. Exceptional items, on the other hand, are a little more common.
Still unusual, but they might pop up once in a while.
Yeah, like if you have to restructure your company or if you sell some assets and make a profit or a loss.
Okay, I think I'm starting to get it. But why are these items a red flag?
Well, companies have a bit of wiggle room in how they classify certain events as exceptional or extraordinary.
Wiggle room, huh? Sounds dangerous.
They can be. They can use that discretion to make their financial performance look better than it actually is.
Hmm, I'm sensing a theme here. Whenever there's accounting discretion, there's potential for manipulation.
You're catching on. For example, imagine a company sells a piece of land and makes a huge profit.
Okay, so they made a lot of money. What's the problem?
Well, they could classify that profit as an extraordinary gain.
And what would that do?
It would make their operating profit look much better than if they just included it as regular income.
Ah, so they're strategically placing these items to create a specific impression.
Exactly. And investors tend to focus on certain metrics like earnings per share.
Right, that's a big one.
So companies have a big incentive to make those numbers look good, even if it means stretching the truth.
It's like that quote we talked about earlier, something about earnings per share being the most important figure for analysts in the market.
Exactly. Companies know that, so they'll do whatever it takes to meet those expectations.
And exceptional items are just one of the tools in their arsenal.
Right. Now, let's move on to changes in depreciation policy.
Depreciation, that's accounting for how things lose value over time.
Right. That's it. Recognizing that assets wear out, become obsolete, you spread the cost over its useful life.
Okay, makes sense. But you said companies can change how they depreciate things.
They can, and those choices can affect their earnings.
How so?
Let's go back to those delivery trucks. Let's say instead of assuming a 5-year lifespan, they decide to stretch it to 10 years.
Oh, I see. So their annual depreciation expense would be lower.
Exactly.
Yeah.
And their profits would look a little bit better. Or they might switch to a different depreciation method that gives them a bigger hit up front and smaller ones later.
So again, they're manipulating the timing of those expenses.
To achieve a specific goal, maybe they want to smooth out their earnings, make them look more consistent from year to year. Or maybe they want to lower their taxes in the short term.
Wow, we've uncovered a lot of sneaky tactics today. From goodwill and off-balance sheet financing to depreciation and exceptional items, it's clear that accounting can be a powerful tool for good or for, well, less than noble purposes.
That's a great way to put it. Financial statements are a story, but it's up to us to read between the lines and look for those inconsistencies.
This deep dive has really opened my eyes. I'll definitely be looking at financial statements with a more skeptical eye from now on.
That's the best takeaway you could have. Stay curious, stay informed, and never stop asking questions.
And if something seems too good to be true, it probably is.
Exactly. And remember, a qualified financial advisor can be a huge help in navigating all this complexity.
This has been a fascinating journey into the world of accounting fraud. Thanks for joining us on the deep dive. We hope you've learned some valuable lessons that will help you protect yourselves and make smarter financial decisions. Until next time, stay curious and keep learning.